And welcome to video number 3. Now we're going to talk about indicators and we are going to have some fun with your indicators. Now, the color legend here, yellow is the 200 EMA, blue is the 13 EMA, and red is the 48 EMA. You also see here support and resistance, and this will be talked about more when we cover the strategy. Now, why do we use EMAs? Because EMAs react faster to price action due to the fact that it's weighted on the most recent data, whereas simple moving averages or moving averages are used for traders with a longer term horizon, multiple months out, maybe years out. Okay. So for this system, we depend on the exponential moving average because it's more sensitive to price action, especially since we are trading on the 1, 3, and the 5 minute. We do have some members in the community who trade on the 4 hour and daily. They are, in fact, using the 1348 4 hour and daily crosses, of which we find that the EMAs work very well as well. Now, there's not one EMA better than the other, but a tool's a tool, and you need the right tool for a job, right? I mean, you don't want to use a flathead when you need a screwdriver, right? So let's go to the charts here. You see here, you will get the put signals, you will get the call signals, and the strategy is very, very simple. We'll go into depth in the up and coming videos, but essentially, if the blue line crosses below the red line, as in the 13 crosses below the 48, you have a put or a short, and you could see price action trending down. When you see a call here, that's when the 13 crosses above the 48 moving average and or exponential moving average. And what you see is price action moving up. Now we are on the 1 minute. If we could take the SPY and put it on the 5 minute, you could see how powerful this trading strategy is. And this is the reason why we play it on the 5 minute, because the larger the time frame, the bigger the move. In this instance, you had a call signal. This is pre-market, but we don't play pre-market, right? That signal is not valid. You could see here, we have a put signal on the 5 minute. There was a great deal of profit made here. And then you get a call signal, and there's profit to be made here. This is why we use the 5 minute. Now let's talk about RSI, because a lot of you use the RSI in a very polarizing manner. Whereas you buy when the RSI gets down to 30 and you sell when the RSI gets up to 70. Using that way of thinking will keep you out of a lot of plays. What we like to do is use the 50 level. Anything above 50 is trending up. Anything below 50 is trending down. And so 50 is our line of demarcation, right? And we're going to get into that strategy as we progress through this video series. Now, you will find that the RSI here has what's called its moving average, and we'll explain the benefits of this. And this is probably one of my favorite indicators to be found here on TradingView. And so this is why we encourage you to sign up. Now you have the MACD. Now this is known as the moving average convergence divergence. And if you have the MACD line crossing above its signal line, so the MACD line being blue and the signal line being orange, when you have that cross above, you are in a bullish trend. When it crosses down, you are in a bearish trend. Now, let me give you proper definition. Moving average convergence divergence, or MACD, is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. And by virtue of the MACD using EMAs. Now you understand why the 1348 is also using an EMA. Next up, we have the shaft trend cycle. So the shaft trend cycle is a charting indicator used to help spot buy and sell points in the Forex market. Now you can use it in the stock market. Now, compared to the popular MACD indicator, which we just went over, the STC will react faster to changing market conditions. A drawback to STC is that it can stay in overbought or oversold territory for long stretches of time. So let's go back to the SPY here, or our chart, and you can see it sort of kind of alerts the buy and sells much sooner than the MACD crosses. Now, this isn't one indicator rules them all kind of situation. What we do is we use every indicator together to create a proper trading thesis. Okay, a proper trading thesis. So we want to make sure there is synergy between all of these indicators, and this would prompt our buys and sells. Okay, so you basically got a breakdown of what the shaft trend is. You got a breakdown of what RSI and MACD is. I also want to just do a quick breakdown of what this is as a moving. Going to hear me talk about this, right? Now, moving average crossovers can be used to confirm RSI indications that a market is overbought or oversold. Now, here we go. As you can see here, when the RSI breaks above its moving average, the equity is in an uptrend. When it breaks below its moving average, it's in a downtrend. And we see more examples of this. As it breaks below, we have significant price dips. Okay, you're paying attention to the chart here. And again, breaks above, and we have an uptrend here. Again, no one indicator is more important than the other, but having all of these indicators work in synergy to help you build your trading thesis is what makes this strategy just click. All right. So moving along to the next video, we're going to break down the rules.